Warren Buffett and other big super investors are currently selling big chunks of their stock portfolios according to new 13F filings. With the S&P 500 along with many different reliable stock market valuations surging to new all-time highs week after week, this recent super investor activity is screaming that the stock market might be overvalued. And with a number of concerning forward-looking economic indicators also painting a worrying picture for the future of the US economy, we could be heading for disaster. So the new 13F filings show that Warren Buffett's Berkshire Hathaway sold billions in stocks in Q3, including some of his favourite positions like Apple. Berkshire Hathaway's portfolio only declined by around $13 billion to $271.6 billion, but when taken into account the $20.5 billion in investment gains, we can see that Buffett had been aggressively selling in total more than $33 billion worth of stocks in the quarter. And Warren Buffett also made $75 billion worth of stock sales in the previous quarter in Q2 of 2024, when accounting for stock gains, meaning that he has sold over $100 billion worth of stocks in just half a year, which is a significant slice of his overall equities portfolio. And Buffett has now raised so much cash from his recent stock sales that his total cash pile has skyrocketed to $325 billion, meaning that he now holds more in cash than he does in stocks, something that is quite unprecedented for Buffett. This is also the first time since 2018 that Buffett hasn't bought back any of Berkshire Hathaway's stock, another telling sign of Buffett's stance on current valuations, even of his own company. With the majority of this cash being parked in short-term US Treasuries, Buffett clearly feels more comfortable sitting back and taking advantage of the extremely low-risk 4 to 4.5% yields that are on offer right now in Treasuries. And this sort of yield does vastly underperform the historic average S&P 500 annual return of around 10%, as well as Warren Buffett's own compound annual returns that have outperformed the S&P 500 of 19.8% that he has achieved from 1965 to 2023. So the fact that Buffett is willing to settle for this yield on such a sizable portion of his overall portfolio really does show us what he is currently thinking about the stock market at the current valuations, clearly expecting the market to perform very poorly in the near future. And Buffett is not the only super investor who appears to be selling up, as we are also seeing various other super investors managing gigantic investment funds selling sizable chunks of their stock portfolios as well. Now this includes Bill Gates, who has trimmed all three of his largest positions in his $45 billion portfolio, as well as the Dodge & Cox investment fund, trimming a good number of their top holdings in their $112 billion portfolio. And it's not just super investors who are taking advantage of the frothy market to cash in, as we are also seeing corporate insiders cash in as well, with insider sales reaching new highs. According to Verity data, the rate of insider sales from executives at companies in the Wilshire 5000 index has hit a record high for any quarter in the last 2 decades, which includes one-off profit-taking transactions as well as regular sales triggered by automatic trading plans. Now, Ben Silverman, Vice President of Research at Verity Data, did say, "With the year closing and the election results, we are getting this giant burst of selling here." He also said, generally with selling, in terms of predictiveness, insiders are early by about 2 or 3 quarters. As they start to see froth in the market is when they try to generate liquidity more aggressively. Now, corporate insiders are in the best position to judge how cheap or expensive the current stock price of their company is based on what is going on inside the company and where the stock price might be heading several quarters from now. It is therefore another concerning sign to see this ratio of insider sellers to buyers reach a new high, as it signifies that insiders are skeptical about stock performance in the near future based on where prices are today. The total stock market to GDP ratio, often dubbed the Buffett indicator, recently surged past the 200% mark to new all-time highs, now at 203%. Now, this metric takes the total market value of US publicly traded stocks and divides it by the US GDP to compare the stock market size to the overall economic output. So when the ratio is higher, it means that you need to pay more for the same level of economic output. And with the metric now being higher than the peak seen during the dot-com bubble, as well as the 2007 global financial crisis, and also the recent 2021 stock market bubble, we can safely say that the market does look quite expensive right now, according to this indicator. Now, the metric is often referred to as the Buffett indicator, thanks to Buffett's long-term endorsement, including him referring to it as probably the best single measure of where valuations stand at any given moment. From this statement, we can infer what Buffett thinks about the market today at its current valuation, which likely explains some of the bearish moves that we are seeing from him in recent quarters. On top of this, the forward PE ratio of the S&P 500 surging to over 22 is also signalling that the market is particularly hot at the moment, which is far above the 15.8 average over time, and is now very close to the highs that were seen during the dot-com bubble and also in the 2021 stock market bubble. We've also recently seen Goldman Sachs come out with a bearish report on the state of the S&P 500, with analysts now expecting annualized nominal total returns to be just 3% over the next 10 years. Now, this would be much lower than the 13% achieved over the last decade, as well as the long-term average. They also see a roughly 72% chance that the benchmark index will trail US Treasury bonds and a 33% chance that the benchmark will lag inflation through to 2034. The other big thing that the stock market has got to fight against, and therefore could hamper performance, is the rapidly deteriorating fiscal situation in the US, and in particular the impending government debt crisis that will inevitably cause problems at some point in the future. The US government has been consistently spending more money than what they are taking in from tax revenue, issuing new debt to the market to raise the money that they need to fund this gap. And this gap is getting bigger and bigger both in real terms and as a percentage of GDP, meaning that the amount of new debt being issued is rising too, and we have just seen US government debt break the $36 trillion barrier for the first time ever. The big problem here is that while the supply of US Treasury debt is rising, the demand is not, and in fact you could argue it is declining, as many investors are rapidly losing faith in the spiralling US fiscal situation. Now, with this imbalance between the supply and demand starting to get worse, the interest rates that the market is demanding on US Treasuries are remaining quite high despite the Federal Reserve now beginning to cut baseline rates. And in fact, looking at the recent charts, we can see that while baseline interest rates have fallen by 75 basis points since mid-September, US Treasuries have fallen in price and the interest rate on them has actually increased. The US government is now faced with annual interest payments of over $1.1 trillion, which as a spending category makes up a whopping 14% of total government spending. Now, the government could decide to keep kicking this can down the road, taking out more and more debt to keep funding the budget gap. However, this means that the problem is likely to exponentially get worse over time, with the debt and debt payments surging higher and higher. The Congressional Budget Office and the Committee for a Responsible Federal Budget do estimate that this would cause spending on interest to basically triple as a percentage of GDP over the next 30 years, from roughly 2.5% today to 6.7% in 2052. This would mean that spending on interest payments would exceed all other programs, which does include Social Security, Defence and Medicare. Now, with interest payments gobbling up so much of the government's spending power, this would have a very negative impact on all other areas of the economy and would hamper the government's ability to stimulate economic growth. Alternatively, the government can cut costs right back and stop taking out additional debt, but new government debt is a major driver of M2 money supply growth, which is a metric that correlates quite closely with the stock market, and when we see contractions in the money supply, we also tend to see corrections in the stock market. Therefore, if the government opts to vastly reduce costs, then not only are we going to see less spending across all areas of the economy, but we are also likely to see a slowdown or even a contraction in the M2 money supply, as there will be less new government debt being issued. Increasing tax revenue is also an option, but hiking tax rates is obviously not a good thing for the economy and the stock market either. If companies get hit by higher corporation tax, then this is a direct hit to all US companies' earnings. And if individuals get hit by higher tax, such as higher income tax, then there will be less consumer spending power across the economy, meaning that many corporations will suffer from less demand for their products and services, and therefore less profit. Warren Buffett himself even said at the 2024 Berkshire Hathaway annual meeting that he thinks that higher taxes are quite likely, referencing that the federal corporation tax is only 21% right now, but was 35% not long ago and was 52% in the past. No matter what happens next, the ever-worsening debt situation is a looming dark cloud over the stock market that could start to have a big impact soon in one way or another. And one big problem that the US could be facing soon is a deteriorating bond market where cracks are starting to emerge and large nation states are pulling out of wanting to own US debt. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.